Well, Victor, thanks for joining me on another episode of Becknomics podcast, and welcome to our first video podcast. Really exciting one.
Yeah, no, I think this is awesome. Looking forward to giving our listeners a little bit of a video as well, and kind of get into a good topic today.
Yeah, so we're talking about the 60/40 portfolio. You want to give us a little background and just history of it and where it is today?
Yeah, so I'd say most retail investors probably some more or less familiar with the 60/40 portfolio. That traditionally being your 60% equity allocation, 40% fixed income allocation. And so this idea has been around for a while. I mean, kind of since the 50s. Henry Markowitz, Nobel Prize winning economist, came up with modern portfolio theory, which was essentially a way to kind of maximize your risk return trade-off whenever you're talking about the assets that are going to be held in your portfolio. And so that was, of course, some kind of combination of, traditionally your equities, your stocks, and then bonds being your fixed income portion. And so the 60/40 really came to be whenever John Bogle started Vanguard and in the 1970s, and he came up with the first mutual fund. And so now all of a sudden you have these passive options for investors to get into equities and fixed income. And then holding that, he kind of promoted this as a way, hey, you can get your passive allocation between equities and fixed income, and this, relatively arbitrary, combination. But the idea was, to get this kind of combination of, when equities aren't performing as well, your fixed income is traditionally a little bit more conservative, might perform better in these market environments when equities aren't doing well. And then when your bonds aren't doing well, your equities are hopefully outperforming. So this was kind of the generic idea behind that portfolio.
Yeah, and so that worked pretty well for a long time with bonds keeping a negative correlation to stocks from about year 2000 until just recently, 2021, is a negative correlation. So, you had that good trade-off. But prior to 2000, you had positive correlation between the two. And I think one of the more notable things is that since 2000, you had positive correlation during times of market stress. So post '08, for those couple of years, you had positive correlation between stocks and bonds. So when you need it the most, that protection that you're supposed to get from those bonds isn't really giving you anything, leading all the way into recent times where the 60/40 portfolio just had one of its worst years ever, if not its worst year ever, come following these Fed hikes.
Yeah, I think that's the issue that investors, whenever you play this, relatively mindless, kind of the more passive game, which unfortunately we see a lot of, institutional wealth managers take this approach too when it comes to their clients. But whenever you just think in the back of your head, oh yeah, bonds are always safe, it's not necessarily going to be the case. I mean, we saw that, in 2020, the 10-year treasury was yielding under 1%. And then you're talking about going into an environment of elevated inflation. You're getting a negative real return on your capital. So why would you own bonds in this period? If interest rates are zero, there's only one direction they can go. And there's this, negative relationship between prices and rates. So if interest rates are going to go up, the price of your bond is going to come down. So whenever everybody's investing in these fixed income, assets, whenever rates are zero and interest rates can only go up, that means the price of your bonds is going to go down. And so this is all, all coming together to say that we think that, when it comes to the 40% of that, 60/40 portfolio, there are just fundamentally better ways to construct this piece of the portfolio.
Yeah, for, kind of like you said, for a passive investor who just wants, some kind of allocation, the traditional 60/40 works great. But, as we're going to talk about in a minute, I think there are a lot of better options when you have a little bit of active management. You have, some more options that some of which aren't available to individual investors.
Yeah, exactly. And I think one other point that I'd like to make about that is that whenever you're talking about a low yielding portion of your fixed income, what you don't want to get in the habit of is, hey, I need to reach for return all of a sudden. And so if your treasuries, say, aren't yielding what you need as far as return for your portfolio, it doesn't mean that the right thing to do is get into junk debt that's maybe yielding a little bit higher, but then all of a sudden you're taking a lot more risk. Your risk of defaults is higher. We're in a more or less, somewhat precarious, especially in some sectors of the economy, kind of situation as far as markets go right now. So what you don't want to be doing is, your answer to getting more out of your fixed income side is just extending your credit risk, going riskier on your bonds to get a higher yield, because that's going to set you up not necessarily for success in the long term.
Yeah, and that's a tempting thing for a lot of investors to extend duration and dip into higher yielding stuff. We saw that with a lot of the banks that came under pressure earlier this year. They're extending duration to try and eke out any amount of yield in that zero interest rate environment. And, like you said, only one way for rates to go is up. And so when that finally happened, really crushed them on that one. So.
Yeah, exactly. And so going back to, what we view as the right way to do, your 40% of your portfolio, we're still big, firm believers in equities. As a long-term investor, having equity allocation is extremely important in the portfolio. I mean, I think, that 60% more or less is going to make sense depending on your individual situation as an investor. But let's talk a little bit about, that other 40% and what we're looking at as far as what makes sense right now. And we've got what I think are a lot of good options now that are going to round out that 40 where, maybe your traditional bonds do take up a percentage of that. But there's so many other vehicles that you can gain access to, especially through a wealth manager like ourselves, that is going to, create a better, what we think is, risk return profile for your portfolio.
Yeah, exactly. Now that yields are a little bit higher, it's not the worst time for those bonds, but those yields also help these other products too, from, private credit to real estate to, all sorts of things. So, Victor, you want to kick us off with, some of the specific ones, the buffered products?
Yeah. So I'll lead us into that. I think, buffered products are something that are relatively new, what we like to refer to as defined parameter investments, where you have, protection to the downside, but equity exposure to the upside. So it is closer to your kind of more traditional, equity portion of your portfolio, but it's providing the protection that you want in a bad market environment. So you're protected. You've got that insurance to the downside, which is going to create value for your portfolio in case there is a market pullback. So, maybe a lot of these products that we're typically investing in have, 10 to 15% protection to the downside. If the S&P 500 drops 10 to 15%, you're protected. And then, you're going 1-to-1 after that. Market falls 25%, but you've got 15% protection. You're down 10%, whereas the rest of the market's down 25%. And so that's where, if you're looking for something that's going to provide that counterbalance whenever you're in a negative equity environment, something like that's going to help. And I know that you are a big proponent, and something that you really focus on in our business is structured notes. And these serve a very similar purpose, but I'd love you to run through that a little bit.
Yeah. So their structured notes they've come a long way in previous years as far as investor accessibility, ease of use. And they can be structured a lot of different ways, but the way, kind of our bread and butter, one of our favorites right now, at least, is to structure them in such a way that you get long-term capital gains treatment, which is not a thing with, a lot of other options in the space. With similar downside buffers, you get that downside protection, but you kind of lock in a fixed return as long as you don't go past a certain threshold. So, kind of taking an example is, maybe you have that 20 barrier on there where it's as long as the S&P doesn't go below 20%, doesn't drop more than 20% in the 13 months, then you're not only buffered, but you're also earning that fixed return. So they can be really great to, moderate those returns. You're not going to see the huge years S&P up 20%. You're still stuck at your 11, 12, but S&P drops 20 and you're still yielding 11 or 12. It's a really compelling thing for a lot of people in this market environment and, just kind of across the board.
Right. And I think that's what investors are typically looking for whenever you're talking about that fixed income portion is, hey, this is that fixed return I'm looking for. And just like a bond, a bond isn't guaranteed to pay you back unless you're talking about a U.S. government treasury, which, we could get into a different conversation about how, the outlook on those is these days with the, growing U.S. debt. But that's what, investors are looking for is that more than likely return that you're going to get out of that, quasi fixed income instrument. So I think to your point, structured investments are a great place to be right now.
Yeah. And it really evens out that curve of returns where, your stocks up and down, even with your bonds too, bad market time, you might be watching the value of your bond plummet, even if you're planning to hold maturity and the price isn't really your sole focus or your main focus, as long as you're getting paid, your dividends. But the way that, structured notes move, it's a lot more gradual. It's very nice, clean, up and to the right most of the time. So
speaking of investments, I think this is kind of where we want to talk about those things exactly like structured notes that are going to smooth out that ride for the investor. I think what's providing a lot of value to retail investors today and a lot of our clients are investments in private companies. So whether that's private equity, having some ownership of a private entity, or private credit where you're lending to these private companies. So what's really incredible stat to hear is that 86% of companies in the US with 250 million or more in revenue are private. So if you're looking to invest in that higher category, cash flow generating, revenue generating companies, if you're excluding private markets, then that's a huge portion of the US economy that you're not getting access to. And the good thing is that now I think a lot of investors who have been in the space for some time and have looked at alternative investments and private companies, they're thinking, okay, well, now I'm going to, be locked up in this vehicle for 10 plus years. I'm going to have capital calls where people are asking me to write a check every 3 months for the next 2 years. I'm not going to see a return for 5 years. The vehicles that hold those have become much more palatable for the investor. Now you're talking about what we call evergreen funds that are, go on in perpetuity that you can typically get into on a monthly basis. They have liquidity on a quarterly basis, and you're very often are going to start getting distributions from these or capital appreciation immediately. So they're marking the portfolios either quarterly or monthly typically. And so you're not seeing the every single day market fluctuations, but you can see that growth in the portfolio over a period of time. And so getting exposure to those, like I said, through private equity, where you are investing in that company in the stock ownership of that private business, or by lending to private businesses, I think also provides a lot of value right now.
Yeah, being able to avoid that J curve in private equity is huge. And we hear these private equity fund managers targeting that, and even they're launching brand new funds, and that's one of their goals is to eliminate that J curve for people, so they're not seeing a negative return, seeing capital outflows through those capital calls for the first several years. Talking about, hey, how do we make this accretive for people day one? And then on the flip side, with private credit, with banks pulling back lending right now, well, private companies have stepped up and they can get paid for it.
Right.
And that's been great to see on that front.
Yeah, I think especially since we are talking about that fixed income portion, the private credit side makes a lot of sense right now. We'll have to do a follow-up podcast to talk more about private markets, because we could spend another 20, 30 minutes just on that to kind of get familiarize investors. But just as a portion of, reconstituting that 40%, I think there's a lot of value there.
Yeah. Similarly, through public and private real estate right now, there are a lot of really, really cool, really interesting private real estate opportunities. Some of the biggest data center projects, ever, but some of the biggest real estate projects ever are in those, data centers and stuff. Huge investment in that space right now. And then also on the public side through public REITs or other vehicles. But those have gotten hit real hard through all this rate hiking. They're still yielding really well, and we'll likely see some of that principal appreciation on the way back down once the Fed finally, completes their pivot and starts cutting rates.
Right. Yeah, real estate accomplishes a lot of the same things as that traditional, 40%, that fixed income portion. You're getting distributions. It's relatively safe as long as you're investing in the right sectors, which, is something that we look at all the time to make sure you're in those right portions. Like say office space may not be something that we want to be involved in right now, but there's a lot of other, you mentioned data centers, a great portion of the market to be invested in real estate. And then finally, I do want to give a little bit of credence to your traditional fixed income. I think it still makes up a portion of this 40, where, you can get into corporate debt yielding somewhere in the 5 to 6% range. Investment grade is going to have a place in a portfolio. I think as long as you're smart about how you're allocating to that, it can still be a part of that 40%. We are just seeing value in all these other places of the economy where we are placing our clients and where we see, that risk return looking really attractive. So to kind of, I think to kind of summarize, we covered, defined parameter investments as buffered products, structured products, structured notes, private investments, private equity, private credit, real estate, and then back to your traditional piece of that 40%, making up what we think is kind of the new 40 of, your 60-40 portfolio, if you still want to call it that.
Yeah, exactly. Well, thank you, Victor, for joining me on another episode of Economics Podcast. And thank you to our audience for joining the first video podcast. It's exciting. Excited to keep doing this going forward.
Definitely. See everybody next time.
So, thanks.